Good morning and welcome to this session of the live coaching classes organized by the Board of Studies of the Institute of Chartered Accountants of India. We continue our discussions on share capital and debentures. Of course, we'll come to debentures in the next session. We are still in equity or share capital, right? So, the last class, let's see where we stopped. We've covered some good ground, but I wish we could have done better. Let's see, today we will try to do better. So we saw issue of equity shares, redemption of preference shares. Yes, we even worked out some small examples. So transfer, transmission. Okay. We also saw partly paid shares. Let's sort of revise that and then move on. Yeah, let me see who's here. Hitesh, of course, is here. Mr. Dete, Meman Rafiq Bhai is here. Mantanjali, Punam, Neha Murarka. I don't see Pooja here, but let's see. I'm sure she's around. I know that you are here because I see your good morning messages. That's it. Anyway, I wish all of you a very good morning. And so let's begin here. In case of loss of instrument of transfer, IoT is instrument of transfer, which is in form SH4. SH4, right? Or delay in submission of IoT, the board at its discretion and conditions of indemnity may register the transfer, right? Because the transfer should be registered within the instrument of transfer, that is in form SH4, duly stamped. In case it's a physical certificate, you should enclose the certificate. If no such certificate is in existence, a letter of allotment is enough, right? So if that is lost, then the board can take a discretionary call. Depends on the company. Some companies will not help you. It's absolutely the board of directors' call. I know a lot of old economy companies, they will absolutely refuse. They will say, no, because most companies are worried about fraudulent transfers. Somebody forging signatures, somebody doing something. So they will be safe rather than sorry when it comes to transfer. Right. Exemptions for government companies. The provisions relating to transfer of discussed above will not apply to bonds issued by government companies. We saw this in the last class. Provisions not to apply to shares held by nominees in a government company. Maybe when we come to management and administration, I will tell you more about this nominees in a government company, or when the president or governor of a state are holding shares in a company, how he will be represented at the meetings. It's a section which we will come across in management and administration. The president or governor will nominate somebody. Now, when these nominees are holding shares, and then the nominees are changed, that is not a transfer. Because the owner is still the government of India or the government of Maharashtra or whoever. Owner is not changing. It's only the nominee is changing. So that is not a share transfer, therefore the provisions will not apply. Moving on, partly paid shares. See, the point, the principle behind it is when the transferee is sending it, partly paid shares carry a liability. So when the transferee is sending it, I don't have to bother because he's accepting the liability. But if the transferor is sending it, application for transfer of partly paid shares by transferor alone, then sorry, notice to be given to the transferee in form SH5. No objection certificate to be received from the transferee within 2 weeks from receipt of notice. The idea is the transferee should know that he is getting the new liability. If not, the transfer shall not be registered. Right. Friends, before we go into failure for registration, okay, we'll finish this and then I'll tell you. Some of you have asked, what is an international financial services center? International Financial Services Center. Okay, this is, as the name implies, this is a financial center that caters to customers outside the jurisdiction of the domestic economy. Okay, you can call it BPO, KPO, financial, services. We a lot of banks, like Standard Chartered or Royals. Royal Bank of Scotland, yeah, and many of these companies have BPOs, business process outsourcing units in India. So these are set up in international financial services centers. They cater to customers outside the jurisdiction of the domestic economy. So the bank has customers all over the world. So they set up a financial services center in India. From that center, they of course obviously hire people from India. That is the whole point of giving them all these benefits and all that. And the chances are these IFSCs will also be situated within an SEZ, a special economic zone or a zone, where they would get income tax exemption, GST exemption and all that. In addition to that, there are also a lot of concessions under the Companies Act. The reason is basically they are not catering to customers within the domestic economy, but they are bringing us a lot of money as foreign exchange. 1, 2, they are also giving employment to our people. So we give them some concessions. This is also known as an offshore financial center. Maybe later on when you come to the final examination syllabus, in FEMA you will come across the same term. Offshore financial center. Offshore, because though it's within India, it is as if it is outside India. That the area of that place is declared as not, governed by the Indian law. This happens under the SEZ Act and all. And so the idea is it deals with flow of finance, financial products and services across borders. Boss, basically it's reconciliation, yeah. And see what happens is guy sitting in Australia transfers money through his bank. It goes to somebody else in say Auckland and whatever. So that, sort of gets cleared in these financial services centers. And entries are passed, bookkeeping is done online. After some time, it's absolutely repetitive work. But then pay is good and you get a sort of, work atmosphere, work from home, all that stuff. So enjoy. But the point here is IFSC will come across this term regularly. International financial services centers are usually are always run as companies. So they may be either a private company or a public company. An IFSC may be run by a private company or a public company. So specified IFSC company is one which is licensed to operate from an IFSC. So that company will operate from a International Financial Services Center. Similar to an SEZ, yeah. Okay, similar to an SEZ, except that in an SEZ, manufacturing can happen, software development can happen, whereas in IFSC, within that center, only financial services will be offered. And that too for customers outside the jurisdiction of the domestic economy. So they will be given a lot of concessions. So I have covered IFSC here. So later on, whenever we come across the term IFSC, please remember this. I may also tell you again, but I don't want to repeat again and again. So the idea is simple. They operate within the IFSC. These companies are licensed to operate within an international financial services center. And they cater to customers outside the jurisdiction of domestic economy. You will never be asked a question in the exam, what is IFSC and all. But there are concessions for IFSCs that you will have to. Concession means the law will not apply to them strictly. The law will be made less applicable to them. That's what it means when I say concession. So the company shall, unless prohibited by any law or order of court, deliver securities as follows. Means, once the company allots the shares, the securities, the physical certificates should be delivered, or the entry should be made in the records of a depository. In the case of subscribers to the memorandum, within 2 months from the date of incorporation, within 2 months. In the case of any allotment of any of its shares, any type of allotment, yeah, bonus, rights, public issue, non-public issue, private placement, whatever. within a period of 2 months from the date of allotment, right? In the case of a transfer or transmission of securities, so what happens is our man sends the instrument of transfer along with the certificate, right? Now, the transferee's name should be entered as the owner. So usually on the physical certificate, on the reverse side, you will find the new owner's name will be entered, right? So that whenever you get a physical certificate, you just don't look at the face of it, turn it around, because the last owner's name would be there in that page. You should ensure that this is the guy selling the share to you, right? So that certificate, that security physically should be delivered to the guy, the transferee, within a period of 1 month from the date of receipt by the company of the instrument of transfer or the intimation of transmission. So 1 month is given. We'll see this more importantly because there is also a remedy for refusal to register. Okay. For debentures, whenever debentures are allotted, the security, the actual physical certificate, debenture certificate should be delivered within a period of 6 months. Okay. An IFSC may deliver securities within 60 days across the board. See, for allotment and subscription, anyway, you got 2 months. But for transfer also, they got 6 months time, 60 days time. Okay. Anything they got 60 days time. That's a concession. So time is given to them because their shareholders may be outside India. That's why they give a longer period. Usually they'll be wholly owned subsidiaries and the holding company would be a foreign company or a company incorporated outside India, or foreigners would be holding shares in that company, right? Now, coming to the point, my dear friends, all these provisions that we saw, all this, right, is for physical certificates, physical shares, where the shares are held in physical form. Okay? Physical form. Right. If it is dematerialized, Baba, all this is out. Why? Because the transaction should be seamlessly concluded within the T2, that is T plus 2. Today, transaction, tomorrow, day after tomorrow, the money should be paid and the share should be credited to the account of the transferee. As per the exchange ka rules, the National Stock Exchange ka rules. So, listed company dematerialized shares, don't even bother. We are only talking about private or public company, unlisted, which are still holding physical certificates. And in a short while, all public companies also will have to move to dematerialized shares, which will leave only private limited companies allowing physical certificates to be held. Right. Now, Mantanjali is asking, IFSC means financial outside. Nay, it is not outside India. It is in India. Please understand. It is in India. Physically in India, but it is licensed to operate within that IFSC. Once it goes into the International Financial Services Center, it is as if it is abroad. Means the law of India with respect to taxation, company law will be applicable differently. Right? Similar to SEZ, special economic zones. Once we create a special economic zone, we give them some concessions. Like we say, our regular GST won't apply to you. Our regular income tax won't apply to you. They have special provisions. Okay. So, but they are in India, very much in India. Okay. It's like you are entering a foreign country, sort of, but then very, very limited. Okay. Only for the purpose of taxation. They get concessions. The idea is simple. We want to promote, first of all, they bring in foreign exchange. 2, they buy from India also. You see, we have Indian vendors supplying to them. So Indian vendors get business, right? And also they provide, which is very important, employment. And why they will come to India? Because of the fact that they have to pay more in their country. So they prefer to hire people from India or maybe even Taiwan, Korea. They are also competing. See, it's not as if we are monopoly here. We were once upon a time a monopoly. Today, Taiwan, right? Even Vietnam is competing with us. They are setting up SEZs and IFSCs. China, of course, is way out there. So the point I'm trying to make is this is meant for promoting that, right? So, good. Yeah, Pooja, I'll give you I will give the solutions. I have the solutions. I will check it up once, and for all the three, I will put it up. For this topic also, I have assignment. I will send it. In the last class, I will share the PowerPoint and also the assignment. This PowerPoint PDF will be shared, and also the assignment and the solution also. So that if you have any doubts, you can ask in a later class. Absolutely correct. With dematerialization, all this is gone. Dematerialization, where the securities are dealt with in a depository, that is in dematerialized form, the company shall intimate the details of allotment of securities to depository immediately on allotment of such securities. No question of 2 days or 1 month, 2 months and all that stuff. Immediately. Similarly, when there is a transfer of shares in dematerialized form, the depository will, at the end of that day, it will be closed. At the end of the day, maximum you can get 1 more day. That's all. So usually what most intelligent investors will do is they'll give a power of attorney to their broker. And anyway, even if you're dealing online, it's going to go through a broker. It's not as if when you're buying and selling shares online, you're doing it without a broker. There's always a broker, okay, through whom you go. Except that you don't call up and talk to your broker. Instead, the broker's site, you are routing your transaction through his site. He gets his commission. Every time you buy, every time you sell, you pay a commission to the broker. And that's it. Even if it's online. That's why they allow you to free account, all that they give you. No? Why? To earn that commission from you, right? And also the DP also will charge for every time you a share is credited into the DP account or debited, there's a transaction cost and an annual maintenance fee. All this, they earn a lot. The point I'm trying to make is in dematerialized form, all this is not there. Immediately, straight away. That is why, we are able to do so much volume in the NSE and BSE. Otherwise, every time you have to deliver, transfer, it's no way. So, which is why volumes are multiplied, zillion fold in National Stock Exchange and Bombay Stock Exchange. Okay. This is just a point. So, this again is a simple question. Stream Lakshmi Jewellery was incorporated on 27th August with 30 persons. Authorized capital of 1 crore divided into shares of rupee 1 each. Each subscriber subscribed for 1 lakh, so 30 lakh. What is the point is, advise the company about the date by which it needs to deliver the share certificates. So, 2 months. Now, friends, is there a difference between 2 months and 60 days? Yes. 60 days is you actually count. 2 months is day to day. So suppose I say 2 months from now, I am now on the 7th of June. So 2 months is July, August. 6th of July midnight, 2 months get over. Right? So 2 months from now, like that. But you shouldn't count for this purpose. For this purpose, you should not include the date of the incorporation, which means 27th not to be included. Right? And you have to move. Stop. So you will start from 28. Got it? You will start from 28th August. 28th August. So 28th August means 27th September, 27th October, which is the correct answer. Whereas if it is 60 days, my dear friend, you will start counting from 28. You will start counting actual number of days. Okay. Where is it said? Is it just me saying it? No, sir. It's the general. There's a law called the General Clauses Act, which is very important. That is why Institute has included it in your syllabus. Somebody will definitely, a very learned advocate will teach this to you because most of it is legal. It talks about simple things like when these dates are to be counted, how dates are to be counted, so many things. That's why it's called the General Clauses Act. So there you will find clearly month means day to day. Whereas days, if it says days, 60 days, then you have to actually count. It could be different, 2 months could be different from 60 days in some cases, because a few months have 31 days. A few months have 31 days. Okay, here's the question. How many months in the calendar have 28 days? How many months in the calendar have 28 days? Any quick answers? I want a quick answer there. How many months have 28 days? Let's see. How many of you give the answer? How many months in the calendar have 28 days? Chalo, moving on. As usual, there is a penalty for default. Entire section, section 56, which deals with transfer of all these rules are contained there. Na? Violation of that section, right? 1 to 5. The company has to pay a fine of 50,000 rupees. Every officer in default has to pay a fine of 50,000 rupees. Just a fine, no imprisonment, etc. Suppose any depository or depository participant has transferred shares with an intention to defraud collusively. So, some of you, let's see. Mari Gupta. Muskan, good. Poonam Sharma says February. Correct. Friends, those of you who told February, don't get angry with me. Those of you who told February, don't get angry with me. All the months of 28 days, yeah. Come on. All the months of 28 days. Some months of 30, some months of 31. February, it so happens, does not have more than 28. But all the months, all the 12 months have 28 days. Okay, so some of you said February, some of you said 28. You might ask me, how is it important for my company law, sir? You are wasting our time. Useless, huh? Not really. A chartered accountant is not just, mug up and vomit knowledge. No. You also have some lateral thinking. That's also important. Later on, you will be told right brain thinking, left brain thinking, blah, blah, blah. Good. Thanks. I don't understand Hitesh Jain's answer. We have to consider 2 months from 1st March. I don't understand the answer. As usual, Mr. Hitesh Jain is like Mr. Kamal Hassan in South India. Mr. Kamal Hassan, recently his movie has been released, Vikram. Many times when Mr. Kamal Hassan speaks, we will not understand what he's telling. That is the greatness of Kamal. That he's so advanced in his thinking, when he speaks, we won't understand what he's telling. Right? So Hitesh is also like that. At least I'm not able to understand. Maybe it's my inability to understand. We have to consider 2 months. 12 months is the correct answer. A lot of people have said 12 months. I'm so happy. All the months have 28 days. Because my grandfather always used to do this. He will ask me all sorts of puzzles and riddles and all. Right from when I was 6 years old, he used to keep on pestering me with these type of things. He was a school teacher. My grandfather was a school teacher those days. And so he used to... and one of the reasons why my English is passably good, maybe not great, but passably good, is because of him. Though he was an 8th standard, okay, imagine, 8th standard only. But he was a BT, Bachelor of Teaching, and he was a teacher, 8th standard teacher. Because he's ESLC, then BT, he was an 8th standard teacher, but his English was superb. And he used to correct my English and teach me English and Sanskrit. He taught me both the languages, and just for your information. Good. Hitesh, what do you mean by we have to consider 2 months from 1st March later on? See, impersonation means acting as if I am somebody else. Okay, I am not the owner of the share, but I am forging his signature or forging the ID proof, whatever. Deceitful personation, or deceit is telling lies. Deceit means telling lies or falsehood. So, falsely acting as if I am a shareholder of that company. So, deceitful personation as an owner of any security or interest in a company, or of any share warrant or coupon issued in pursuance of this act, and thereby obtains or attempts to obtain any such security or interest or any such share warrant or coupon, or receives or attempts to receive any money due to any such owner. So they said it can happen, yeah. See, for example, I know I'm helping one gentleman now. He's now 89 years old. He's got shares in a very, very leading company. Value of that share is today worth 40 lakhs. Just 40 shares he's got worth 40 lakhs. It's very, very big company. He's got 40 shares. He's got 40 lakhs worth of shares. Point here I'm trying to tell you is he has come to me for some support and he wants me to help him out. So I'm going to fill up all the forms for him, etc., etc. Now it's quite easy for me to do some nonsense, so forge his signature and then transfer it to me myself. Okay, so all that is for fraud. I'm saying because I'm just giving an example. Somebody could do it. No, but so point is, when that happens, here imprisonment, minimum 1 year, maximum 3 years, and fine, minimum 1 lakh, maximum 5 lakhs on a complaint. So you have to be very, very careful when this is a punishment given for such personation, right? So now we come to a very important topic, but the relevance of the topic I'm not able to understand because this topic is relevant only for non-dematerialized or physical shares. Dematerialized shares again and again was once it's dematerialized immediately. Primary, if you are allotting the share immediately, you have to inform the depository on allotment. This will be usually done through people called share transfer agent. Whenever there is an IPO or an FPO, all listed companies will, to my knowledge, 98% of listed companies will have hired somebody called share transfer agent. These are service providers who will, because the volume of transfers are so huge, the company will not have a division of its own. It will outsource it. So the share transfer agents will have 1,000 or 500 companies for which they will do the service. They will have huge servers where the records will be stored, and they will also have DP. But their job is not DP. They would only keep track. Once the information comes from NSDL and CDSL, instead of going to the company, it will go to the respective share transfer agent, who will download the entire transfer data from NSDL and CDSL. See that each company will have a unique ID. So NSDL and CDSL on a daily basis, they will collect the data for every company and have a sort of a huge file. Now out of that, our friends, the share transfer agent will monitor only his company. So NSDL and CDSL both, they will have a secure line, very, very secured line. And where I have done I do the IS audit for this activity, so I know what it is. It's very, very important. Separate list line. It won't be part of the regular network. Directly it will go to NSDL and CDSL. Directly the data will come in. And once it comes in, it will be dumped here. Then these fellows will have software that will pick it up and immediately process it. And immediately the register members also will be updated. Everything is happening almost instantaneous, or maximum 24 hours. So that then they will inform the respective DP. That will already go. NSDL. The DPs will be accounted. The company register of members will also be updated by the transfer agent. Whereas NSDL and CDSL in turn will inform the respective DPs. For each, the seller's DP will be informed by his DP. Automatically, the DP records will get updated almost instantaneously. But see, at the end of the day, you will find everything is over. Accounts will be settled. Payment, you got another 1 day. T+2 actually. So you can, if you buy the share today, you can give the payment maximum. By day after tomorrow, it has to go. Otherwise, what will happen? The transaction will be closed out and it will come back. Okay. So the T+2 delivery is there. So most brokers also will hold the share in the DP account only of the seller. Once the money is come, immediately this will go. That day it will get closed. That's why I said maximum to 48 hours it will get. Okay. But online trading stayed away. As you buy and sell, at the end of the day, it will be only adjusted and recorded. That's all. So all I'm trying to say again and again is this particular part is applicable only for physical. So don't confuse dematerialization shares and all. We don't have this type of time limits and all that. Okay. Now, there are two sections or rather two aspects, private company and public company, 58.1, 58.2, right? 58 has two thoughts. Where a private company refuses to register, transfer or transmission, the following rules will apply. Now, a private company may, by its articles, contain certain clauses which say it can be only transferred to the members, existing members, then later. Whatever it is, between existing members also, if there is a transfer and they transfer it, the private company should register it. If there is a refusal to register, transfer or transmission, we already saw what is transfer or transmission. Transfer is by volition, by voluntarily I transfer to somebody, sell, gift, whatever. Transmission is due to operation of law, inevitable circumstances, as I think Pooja or somebody said it, or Mantanjali, inevitable, death, insolvency, etc., etc. Okay. Now, so very important date is the date of delivery of IoT, date of delivery of the instrument of transfer or intimation of transmission. So from that date, notice is to be given to the transferor and transferee within 30 days. If there is any refusal, if you are refusing to register, you have to give the notice to the transferor and transferee within 30 days, along with the reasons for refusal. The reasons for refusal shall be given. So you can't just like that say, hey, I don't like your face. No, that is not a reason. You have to give a valid reason why. Possibly, the only reasons you can give are you are transferring to a person who is, according to the articles, he cannot be transferred. Because there is a restriction on transfer of shares, right? There is one of the concepts of a private company is that restriction on transfer of shares to persons other than members. Therefore, they can say, as per the rule you go. There is only one reason. Otherwise, court order. No. So, other than that, if everything is through clear, no problem, member to member or death of a member and his illegal heir is getting it, you have to register within 30 days. See, this 30 days has a connection here. 1 month. Transfer or transmission should be registered and that security should be sent within 1 month. So that 30 days time they give you. This is 30 days, that is 1 month. Chalo, no problem. There may be small delay, difference between the two once in a while. It's okay. Point is, that is it. In case you are not registering it, you have to give the reason for refusal within 30 days. On receipt of it, he can appeal. Who? The transferor or transferee can go on appeal. I'm sorry, transferee, because he is getting the share now. So transferee can appeal to the tribunal within 30 days of receipt of notice of refusal. So let us say that I deposit it on the 15th of, today, 7th of June, 30 days from now, June. So we have to count 30 days roughly, and then say they give you on the 25th of June, they give it to you. Then from the 25th of June, within 30 days, you have to make an appeal to the tribunal. Suppose you waited for 30 days. 30 days means you have to count, right? From the date of delivery of the instrument of transfer. Here you can't miss that date and all. From that date you have to count. So 1, like 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, like that you have to count. Okay. So 30 days, right? So 7. So balance days are there. So from 7, if you are counting 6, so 30 minus 6, 24. 24 plus another 6 days in July. That means 6th of July. You see, when the month has 30 days, it will come correctly. 1 month and 30 days will be the same. So only for those 31 and 28, like February month, you will have some differences, right? Chalo. So if the company does not intimate refusal, give the reasons within 30 days, then on the expiry of 30 days, you can appeal. The appeal by transferee to tribunal within 60 days, in case no notice is given. Please note, 60 days is counted from the date of delivery of the instrument of transfer. So, the total period is 60 days, but see what happens is you wait for 30 days, then another 30 days. So, if you're going, there's no, if there is a failure to give notice of refusal, then from the date of delivery of instrument of transfer, within 60 days, you can make an appeal, right? Just you need to understand that the 60 days is counted from the date of delivery of the instrument of transfer. Whereas, in case there is a refusal, from the date of refusal within 30 days, right? So if there is no refusal, nothing, silent, then you wait for 30 days. Then from that 30 days, you count 60 days from the date of delivery of instrument of transfer. In that time, you can appeal, right? Should almost be the same in all cases. Since you are counting days, there is a slight difference maybe. But the 60 days is counted from the date of delivery of instrument of transfer. Now, 58.2 talks about shares or other interest of a member in a public company shall be freely transferable, because public company, no restriction. Private company can put reasonable restrictions like only to members and stuff like that. But public company, freely transferable. So, where a public company without sufficient cause refuses to register transfer or transmission, the following rules will apply. Same logic. There is no big difference between this and this. Date of delivery of instrument of transfer, refusal by company without sufficient cause, because you can't give reasons and all. Private company can give a reason. They can say you are transferring it to a non-member. You are whatever. Okay, they can have some reasons for refusal. Court order is there. Stay from the court has been obtained. We have obtained the stay. See, like that. Sometimes in private companies that could happen. They may obtain they may not want a change in the ownership at that point in time. So three brothers. So one brother will go and get a stay for change. So once that court has passed the order or tribunal has passed the order staying, then later on you'll see a lot of provisions where tribunal can stay. Tribunal can say there should be no registration of transfer of shares like that. Okay. But for a public company, there can be no question of reasons. Where there's a refusal by company to register transfer or transmission without sufficient cause, they have to give the intimation of refusal within 30 days. And the only difference is the person in a public company, the transferee has 60 days to appeal. He's got 60 days to appeal. That seems to be the only difference, right? 60 days for appeal. Okay. So correspondingly, for appeal, in case there is no notice of refusal being given, then from the date of delivery of instrument of transfer, you have 90 days. See that extra 60 days you are adding here, that's all. There you had only 30 days. Now you have, see here you had 60 days from the date of instrument, delivery of instrument. Here you have 90 days. This 60 is getting factored into our equation. That is all, right? So, actually fairly simple topic. I don't see any issue. Once you go on an appeal, the tribunal will hear the matter, see whether the company is, in both the cases, the company has been done. The company is correct or the member is correct. If they feel that the company is right, because there are some cases where, especially for public companies, there could be other issues. So they may dismiss the appeal, or they may direct that the transfer or transmission shall be registered by the company. Direct that the transfer or transmission shall be registered by the company. When the tribunal passes an order for registering, the company shall comply with the order within 10 days. No appeal, etc. No talking. Do it. Also, they can direct the rectification of the register of members. They can say, include his name in that list. And of course, if there is any loss because of this, direct the company to pay damages if any sustained by any party aggrieved. Say, I am the transferee, you are a public company, and you have refused to register my transfer. Now, because of that, I am not able to sell the share. So that I am losing money, interest. So that can be claimed and paid as damages. Good. Pooja only said inevitable circumstances. Now, Pooja is asking which authority will be imprisoned. The person who is imprisonment only for impersonation. Impersonation will be only the individual who is forging or who is doing. One individual will be imprisoned. No authority will. I don't see any authority being imprisoned here. Okay. See, if notice is given after 40 days, my period of 30 days is over now. Okay, I can do. Which is why they said, see, now you can't, okay, you cannot argue, I received the notice only 40th day, therefore from that day, I will count 30 days for my appeal. No, that is why they are saying whatever happens, you can go on appeal within 60 days or 90 days as the case may be. However, even if they give it late, you keep waiting for it, chalo, no problem. Your total limit is 90 days for public, 60 days for private. Got it? So if your argument or you are trying to think that if it's given on the 40th day, I have another 30 days from the 40th day, no. If that is your view, kindly correct yourself. Totally you got 60 days, totally you got 90 days now. That is up to you. So once on 30th day you have not got it, madam, you go on appeal. Who's preventing you? Wait for 30 days, go on appeal. So if you're sitting duck like that and then 40th day they give you, again only 20 days to go on appeal or whatever. Okay. So this is the point. Agreed. Now, refusal to register, transfer or transmission, where there's an order under section 58 and there's a penalty, there's a contravention of the order, then the person contravening the order, okay, imprisonment of minimum 1 year, maximum 3 years, fine 1 lakh up to 3 lakhs. This could include the company secretary also if he has been or she has been made responsible for the transfer or transmission, right? Only individuals can be imprisoned. So companies cannot be imprisoned. Please understand. See, this is another concept where suppose somebody's name has been entered in the register of members or later has been omitted or removed from the register of members fraudulently or without sufficient cause. Name of any person is either entered or removed. Both ways it's danger. No? Entered when it will be possible, when partly paid shares are there and your name is entered there, your liability is there. Therefore, or omitted. Then in those, or there is a default or unnecessary delay in entering the register. Okay. You can go on appeal against that also and the same provision is there. That is why you have direct the rectification of the register. That is also possible. So the tribunal will direct the rectification of the register, right? Who can appeal for rectification? The person aggrieved. Any member, because see, when somebody's name is included, he is not a member, but his name is included. I am also affected as another member. Now, as a member, I am affected. So I can go on, I can say, sir, so-and-so is not a shareholder, he doesn't have own shares, but his name is entered, or he is not holding 10%, but he is shown as holding 10%, whatever. The company itself can. The company, this is where you have to really understand. See, person aggrieved, okay, my name has been wrongly entered or my name has been omitted, I will go. Any other member, when my name is entered wrongly without being a member and my name is there, any member can complain. How the company will go on appeal? This is, to understand this topic, my dear friends, I can't explain it now. Right now, company here, what does it mean? Think. Obviously, this nonsense is being done by the board. The board of directors is entering somebody's name or omitting somebody's name. Now, they are not the company. They are only the management. They are only the brain. The heart is elsewhere. The members of the company. Keep this in mind. Okay. I will not elaborate now for want of time. But when I start management and administration and come to meetings, I will revisit this concept. It needs a little bit of understanding. Okay. Therefore, let us not bother. If you have this thought, sir, how company can appeal? After all, it is a company that is, no. There is a dichotomy, distinction between the board of directors or an officer and the company itself. The board is not the company. More about it later. Okay, I will, when I go there, when I talk about a particular meeting, type of meeting, I will tell you for this purpose also it could be held, right? So we'll talk about it in detail, don't worry. So if you are still not clear how the company will be able to appeal, don't worry. The power is there for the company to appeal. Then you go home, after you finish this class, keep thinking, who is the company? Who is the company? That's all. So I am giving this to you as a contemplative exercise. Keep on thinking. Since you are all students of company law, that too attending my class, and through me the classes of Professor K. Anantharaman, my guru, I expect that you are all intellectuals. So don't expect answers today. Your answer will come on Saturday. But till then, what I want you to keep thinking, who is the company? Who is the company? Not what is the company. Who is the company? That's all. Don't expect answer today. If you know any, if you get any answer also, don't put it now. Don't put it now. Not that you can put it, but don't do it now. Think and then put it. Many times, I have also been guilty of this mistake. The minute I hear something, I will talk. Slowly as I get older and older, I have decided, listen, analyze, think, and then speak or write. If you follow this in your examination, believe me, many things will come out correctly. Students rush into the answer. Don't do that. Wait, think, analyze, think again. Maybe another view. Then go there. Appeal is made to whom? Indian members will go to the tribunal. Indian members can go to the tribunal. Foreign members can go to a competent court outside India specified by central government. So many foreign courts have been identified by the central government as equivalent to the tribunal. They can go there instead of coming to India because we have treaties with those countries. So our same way that country has allowed our country citizens to go to our court when the matter is against the foreigner. So it's in bilateral agreements are there. Based on that, foreigners members can go to the competent court outside India. So in this case, when there is a tribunal, for the rectification also, the tribunal can dismiss the appeal or direct the transfer or transmission shall be registered by the company within 10 days. Direct rectification of the register or records of a depository. Direct the company to pay damages if any sustained by any party. Same. See, which is why in the old company law, this was a single section. In the old company law, both these concepts, refusal to register, transfer and rectification of register members were in a single section, 111. Okay. But now they've made it into two separate sections, but basically the powers are the same. The powers of the tribunal are the same. Except that here, since you're dealing with registration of transfer and transmission, they can direct that the transfer or transmission shall be registered, and once it is done, within 10 days. Here, one of the things is his name is omitted or entered. If it is entered, then or omitted, where I have received, but done. So here also they can direct that the transfer or transmission shall be registered within 10 days. Once order is passed, shall. Okay. Tribunal may also direct rectification of members or the records of depository where the transfer of securities is in contravention of SCRA, SEBI, or any other law. So where there is a contravention of any law, members may complain. See, any member can apply. Members may complain and they can say, see, this will usually happen. This rectification of members will usually happen under the SEBI guidelines for takeover code. There's a takeover code which has to be strictly adhered to for listed companies. So if you want to take over a company, there is a code which you will learn when you come to SEBI, hopefully, or if you are doing a ACS, you will learn it. As per that code, there are many, many provisions. You have to disclose. You have to do it transparently. If anything is missing, then you can go to the tribunal, and since there is a violation of that code, they will say, sorry, this acquisition is not valid. Therefore, remove the name. Like that. Okay? A lot of famous cases are there where they have done it. Or you can show that so-and-so is a known person who has caused other companies to be badly managed. He has a track record of bad management. Therefore, if this guy becomes a owner here, this will happen to us. Like that, a lot of provisions are there. Don't worry. Such provisions are there where Under those provisions, you go to the tribunal. Tribunal will direct the rectification of members. Under the Companies Act itself, there are other provisions in the final syllabus where you can go to tribunal. Whatever it is, 59 empowers the tribunal to rectify. Which is why, see, your syllabus is unfortunately cut into two parts. Rightly or wrongly, 148, then above, beyond that. But then, Companies Act is a single whole. So here, okay, the topics are such that your lack of knowledge of final syllabus will not affect you. But when you go to the final examination syllabus and studying, or when I'm teaching you in final or somebody is teaching you, remember much of this knowledge is expected to be retained there. It is not like a university syllabus where you wrote the first year, forgot, next second year is a fresh, no. Or be 5th standard, 6th standard promotion, no. Even in 6th standard, 9th standard, 10th standard physics, if you don't remember your 5th standard physics or 5th standard basic algebra, 6th, you cannot solve advanced problems in trigonometry. Therefore, this knowledge, please don't forget. Some of the fundamentals, you can't go there and you have to know it. Okay? You can't say, sir, that is intermediate syllabus, sir, like that. No. It's still going to be there for fun, which is why I learned it well here. Okay. Right? So, all these people can make an application. SEBI can also make an application, as I told you. When there's a violation of SEBI, they can do it. Officer of SEBI will be there who will do it. We move on now to alteration of capital. Alteration of capital. Before that, I just check if any queries are there. If not, okay, I don't see any queries, which means topic seems to be fairly simple. This is also fairly simple. Let's rush through this. You all know that there is a capital clause. In memorandum, there is a clause called the capital clause. Now, that capital clause can be altered. How? By passing a special resolution. We studied it in that topic. But for what purpose can I alter my capital clause? For one, increase the authorized capital. So, I'm having 1 crore divided into 10 lakh shares of rupees 10 each. I can increase it to 5 crore, 50 lakh shares. Chalo, pass a special resolution under 61 and proceed. So there should be an authorization in the articles. Consolidate and divide all or any of its share capital in the shares of a larger amount than its existing shares. Means currently I'm having 10 rupee shares. I can consolidate it and divide it into 100 rupee shares. When I combine 10 rupee shares, it becomes 100 rupee share. Consolidate, right? Or divide. Means I have 1 10 rupee share, I can divide it into 10 1 rupee shares. Mostly divide is what happens. When company goes for listing, it will go for with a 10 rupee share. But then the price of that company share will keep going up in the market, yeah, because of the Infosys started with 10 rupee shares. Over a period of time, it became so huge that they subdivided it. Into, okay, subdivide is coming later. I think B is about consolidate and divide. That is, you consolidate, make it whole, and then divide it differently. I currently have 10 lakh shares of 10 rupees each. Now what I do, I consolidate them into 10 lakh shares and then divide it again into 100 rupees shares. 1 share, 100 rupees. So in a way, I'm combining 10 rupee shares to make 100. Or convert all or any of its fully paid up shares into stock and reconvert that stock into fully paid up shares. We already saw what is stock. Means 1,000 shares will be combined into one stock. So that can be traded on the market faster. So instead of when shares are bought in bulk, like 20,000 shares, 50,000 shares, instead of buying 50,000 shares, I will buy 50 stock, 50 units of stock. Means 1 unit is 1,000 shares. Okay, I'm again repeating, don't ask any question on stock buck. No company has done it in India. We still prefer to trade in shares only, not in stock. But in advanced and, shall we say, developed markets, the volumes are so huge that on a trading level now, they prefer to trade in stock rather than individual shares. In India, no, it's not come. So don't waste your time on areas where we don't have it in India, but provision is there. Friends, it's an enabling provision. If a company wants to issue stock, they can. If a company wants to convert fully paid up shares into stock, they can. right? It's like an enabling provision. This is called enabling provision. Enabling provision, my guru, Professor K. Anantharaman used to say, I still remember him and I miss him. Okay, I miss him. Sometimes I still have his number in my mobile phone, and something I'm searching, I'll see his number, and I feel so bad. I wish he's alive. Anyway, point here is, he used to say, enabling provisions are like spittoon in the railway station. See, there, spittoon means for people who chew pan and all, you can't spit it everywhere. Yeah, there's a special place called spittoon where you have to go and spit. That you can't swallow the tobacco, so you have to spit it. So that's called a spittoon. Okay. Now it says spit here. Doesn't mean every time you go, simply you have to spit. Even if you don't chew tobacco, you don't have to spit there. This is meant for those people who want to use it. It's called enabling provision. So don't worry. Right? That is, enabling provisions are there in laws like company law, where they say if you want, you can do. But every time you pass it, you don't spit. Because it says spit here, sir. I have to obey. No. If you want to spit, please go and spit. Otherwise, no need. So don't. That's called an enabling provision. Okay. Anyway. So similarly, they can subdivide. Means what? Infosys is a classic example. They started with 10 rupees per share. Then the share price started booming, zooming. And then, one share worth 3,000 rupees. Yeah. 10 rupees share worth 3,000 rupees. Nobody can, it went up to even 8,000, 9,000. Correct. It went to 10,000 rupees in the .com crash. At that time, they subdivide. Because, see, one share worth 30,000 rupees or 10,000 rupees. I can't buy one share. 10 shares and all can't buy. So, in order to give the opportunity to the public, they subdivided. Each 10 rupee share, they subdivided into one share of 1 rupee each. So, Infosys ka one share face value is 1 rupee. They subdivided. Many companies have done it. I can give you Infosys offhand. I'm not able to give you any other company. I'm sure you may also know companies whose shares are less than 10 rupees face value. Less than 10 rupees face value. It's possible because see what happens once I subdivide it, immediately what happens? The per share value will come down in the marketplace, right? So, see, my share price is 10,000 for a 10 rupee share and I subdivide it to 10 1 rupee shares, immediately per share value will become 1,000. Now, budget is there. So, somebody can buy 5 shares, 5,000 rupees. Earlier, he couldn't even buy 1 share because 1 share was 10,000 rupees. He can't buy half a share. Now he can buy 5 shares. That is why they will subdivide. It happened. Many companies have done it and they have subdivided the shares. In fact, some companies were eagerly waiting for subdivision. There's a famous company in South called MRF. 1 share is worth 70,000 rupees or something. Yeah? 70 or 80,000 rupees. Okay. Now, so, but that company, it's all 10 rupees share, 10 rupees. That is why 80,000 rupees. The minute I subdivide it, 8,000, but even then costly. But definitely, 8,000 is better than I can buy 2 shares. Poor man like me can buy at least 1 share. Okay, point. Also, they can cancel shares not taken up and diminish share capital to that extent. Meaning, at the time of incorporation, I had in my memorandum, I put authorized capital 100 crore or 50 crore. But company never went, it never grew that big. At the time of starting, I thought I'll be big shot, but then nothing happened. And maximum my need was only 10 crore. Whereas my authorized capital is 100 crore, 50 crore, 100 crore. My fee paid to the ministry is high because based on my authorized capital. So finally the board decides, Baba, let us diminish it here. Call the company secretary, either out. Company secretary, out here. Either out. Do this. So that is the job of the company secretary. He will, what has to be done? Immediately he will say, sir, special resolution has to be passed, sir. Alteration in the memorandum, sir. Sir, your articles are not authorizing it, sir. Therefore, you have to alter your articles, sir. For that, you have to pass a special resolution, sir. For that, you have to file MGT 14. All this boring stuff the company secretary will do. You and I are chartered accountants, okay? But we should know what is to be done, okay? Then, because just like, see, I am a cardio surgeon going there and my job is to just operate and come. I just do a bypass, come out. But I need an anesthetist, yeah? And I cannot be totally ignorant of what that guy is doing there. So I should know what he's going to, and I'll give him some guidelines also. Before I start, ensure that things are true. Then I'll take a signal from him and then only go there. Otherwise, I can't I can't cut open. Okay, because the guy will start screaming in pain. So I should be ensured that. So like these are guys like companies that it is like an anesthetist or support guys, We chartered accountants take the decisions and we give the advice to the client, and then we include all these guys around us, create a team, and we execute that. Got it? So sometimes I may need more specialized knowledge, a super specialist, a lawyer. So specific to that thing, I sent the company only for that to the lawyer and ask only one question. In this case, what is to be done? So he will only drill down there and give his opinion. But he will send him back to me. Okay, and I will take care. But for that one thing, I'll send him to a lawyer. Like that. So that is the role of a professional CA. But for all that, we should know minimum something. Now see, if I'm going to send somebody, if I'm going to advise a client and say, hey, this order is bad in law. The reopening itself is questioned by us. Now this guy has reopened it. Now the order is passed. Now it's bad in law. He didn't give us a reasonable opportunity. Go up for a writ. So I can't take him to the court. Yeah, I can't appear before court. So there I need the lawyer to go there. So at that time, the lawyer will go and do it. So what I'm talking about is today, practice is a multidisciplinary approach. It is not same man need not know or do everything, cannot do. So, but we need to know who can do what quickly. For example, client needs actuarial valuation, like that. What valuation, registered valuer. So what easily 10 to 12 different professionals are involved in advising a corporate client. I need to have all of these guys on my panel to do it. But then the first time the client comes to me and he says, Srikanji, this is what we want. They tell what they want. They put the wish list. Then I have to craft a solution. Then in that solution, I'll have to bring in these guys and see that everything goes on from A to Z. So I'm just giving you this possibly useless information only because of to give you the practical aspect of you as a chartered accountant. Getting a piece of paper that says you are a CA is not like a university degree. It's going beyond that. Okay. Then maybe you will get a job, some finance job somewhere. Good. That's also good. But then if you're aspiring to practice, then it's a different ball game altogether there. So now cancellation of shares is something very peculiar. It is not reduction of share capital. What is the difference? Simple difference. You'll easily understand it. Where the share capital has not been issued, I can diminish it, cancel it. Where the share capital has not been issued, subscribed, paid up, I'll repeat. Where the share capital has not been issued, subscribed, paid up, it is not taken up at all. No, there are no owners for those shares. I can cancel, diminish. But suppose the shares have been issued, paid up, subscribed and paid up, then I can simply cancel, somebody is the owner of those shares. I have to go through a very elaborate provision which we will see called reduction of share capital. Reduction of share capital, which is very, very complicated. You have to go through it, etc. Okay. I don't see too many questions. I shall presume in my favor that things have been explained. 59.3, please explain. Neka Murarka, let us see. Understood now. Hey, that is thanks to Narayana Murthy. They did very well. 59.3. Hey, don't give me subsection. You tell me which one because I don't remember which subsection is which. So you are telling 59.3. Kindly, can I make a suggestion, Ms. Murarka? Kindly ask a question on 59.3. What is your doubt? I'll be happy to answer your question. Okay. Specific question on 59.3. What is your doubt? I will answer. Or tell me which point you want to be re-explained. I will explain it. Okay. Or else after the break I'll do it. But humble request is, you are putting it 2 times now, 3 times put also I won't explain unless you tell me what you want me to explain. Sorry, this is the way I work. You know that. Now we come to rights issue. Preemptive right of equity shareholders. Fantastic. Very interesting area. Again, conceptually, if you understand rights issue, then you can. Okay. Before I go there, let me take up Pooja's question. Madam, forget what I told about 10 rupees, 30,000. I don't know. I don't have the data. What happened was when Infosys came, this fellow Ketan Parekh also was rampant. And the dot-com foolishness came and all that. And market simply bulleted up. Not only Infosys, Polaris, all the IT fellows got overvalued. Then, of course, the market got totally, they went for what today you might call haircut or whatever. Not haircut is for bankers. This is complete cut. Market got cut, everybody got cut, people committed suicide and all. Post to get them break cut. But during that dot-com thing, all these IT fellows went up due to many reasons. But out of this, Infosys was already a good company, ethical, very good market savvy. A great man called Narayana Murthy founded it and built it up, of course. And so it sustained that and survived the dot-com crash and continued to be an important company in the tech field, IT technology. So the 30,000 data, maybe I'll take it back. But definitely it went up to 8,000, 9,000, 10,000 and all that. I remember that. 30,000 maybe. Exact data I don't know. I don't have. So that part alone, as a member of the Institute of Chartered Accountants of India, I will take back. But even 9,000 is pretty high for a 10 rupee share, right? That is why they subdivided to 1 rupee shares. Cancellation, I thought I had given a clear example. Now, see, I gave an example. Okay, I will check it up and I will explain that if it is important, I will cover it. Sometimes I might not have included something in my PowerPoint. In case it is left out, I will definitely work. Think if it is important, I will cover it today. Otherwise, in the next class, I'll cover it. Okay. Good. So thank you, Nalini, for your input. Thank you very much. Okay. Cancellation of shares. I gave an example. Now, I'm having 50 lakh worth of 50 crore worth of authorized capital. 50 crore. But I'm using only 10 crore. Balance 40 crore or even 30 crore, I don't need. So already it's there in the memorandum as authorized capital. I will pass a resolution by which I will cancel the 30 lakh worth of shares or 3 lakh shares, 30 crore worth of shares, that is 30 lakh shares. I will cancel it and remove it. After that, those shares will not be in the authorized capital. My authorized capital will be brought down. I don't use the word reduced. But what I'm doing here is I'm bringing the authorized capital down, right? But reduction of capital is when I will bring the paid up capital down. The authorized capital will remain nothing will happen to it. Suppose a company is having, simple example, 5 lakh shares of rupees 10 each, 50 lakhs. Out of that, only 1 lakh shares of rupees 10 have been issued. Now the company feels 50 lakhs authorized capital not needed. So they may reduce that or bring that 50 lakhs to 20 lakhs. How? By cancelling the 2 lakh shares. For that, they have to pass a resolution, special resolution. It's an amendment to the memorandum. Okay, later on, you'll be seeing reduction of capital where out of this 10 lakh shares, 1 lakh shares issued, 10 lakh worth, it is not truly represented by assets. The company has been incurring heavy losses. To that extent, they want to reduce it. Then that 1 lakh itself will become 10,000 shares paid up. 1 lakh paid up capital will overnight, after this reduction is approved by confirmed by the tribunal, become 10,000 shares. Which means the authorized capital will continue to be 50 lakhs, but the paid up capital from 10, it will come, or 1 lakh shares, it will come to 10,000 shares. Got it? So there's a slight difference between cancellation and diminution. Right? See, now what happens? No, I have explained it, but I don't know if you have understood it. So in case you have understood, then you give a acknowledgement. 59.3 I will cover, not abito, no, not now. I will give a small break around 8:30. At that time, I will definitely tell you what it is. Okay. Now we go to rights issue. Rights issue is also known as preemptive right of equity shareholders. The preemptive means it is superior to all other rights. The preemptive right of an equity shareholder is superior to all other rights. It is available only to equity shareholders, including DVS, differential voting rights holders also are entitled because they are to be treated otherwise as equals. Okay, so that their voting rights are restricted. They also entitled right. So preemptive means priority, superior. So like Spice Max. See, if he is there, then he goes first. So nobody else can go. So this provision enables the existing equity shareholders to get priority when company makes a further issue of shares. Now the conceptual point is very different. See, today everybody is going for rights issue, etc. But the real reason for rights issue is, suppose a company has a majority group and a minority group. Suppose the promoters are holding 60%. The remaining public are holding 20% or 30% shares. Promoters are holding 70%. The remaining people are holding 30%. Sort of minority. Now the company goes for a further issue. Like, so if in case that further issue, the promoters allot it to themselves, what will happen? Their shareholding will go up. The other people will remain the same, but the proportion will go down, right? So what they say is, it should be like a proper enlargement. When a photograph is enlarged, which part will be enlarged more? That's stupid, right? All parts will be proportionately enlarged. Nah? So proportionately we have to go up. So when let us say that a company is currently having 2 lakh shares, or let us say 1 lakh shares. Out of that 1 lakh, 70,000 held by promoter group, 30,000 held by others. Company is going for further issue. 62 says, when you're going for a further issue, you should give to the shareholders, the existing shareholders are entitled to receive equity shares or be offered equity shares in proportion to their current holding. So this 100,000 shares will be offered in proportion. That is, only 70,000 will be can be applied for by the promoter group. The remaining 30,000 will be offered to the other shareholders, right? So that way, if they are intelligent and they buy the shares, what will happen? The majority cannot dilute the minority by allotting more shares to themselves without offering them to the minority. Suppose this provision is not there, the entire 1 lakh will go to these guys. So in the post issue, after that 1 lakh issue, what happens? Out of the 2 lakh shares, 1 lakh 70 will be with the promoters, 30 will be with the others. Now if you calculate, the proportion will be less than 30%. So slowly they'll get diluted. Okay. So the purpose of section 62 is to prevent dilution of the minority. One more point. We saw that application for shares is an offer and allotment is acceptance. Nothing happens with the prospectus. Prospectus is only an invitation to treat. But in rights issue, it is the reverse. The company is compelled to make a rights offer. It is preemptive. The company has to make an offer to the other existing shareholders. Right? So the 30% wallahs don't have to come and ask for shares. They simply keep it. The company will send an offer saying, we are going for a further issue. As an existing shareholder, you are entitled to 1 share for every 1 share held by you. In case you want to apply, please fill up the form and send it to us. We will allot. So the offer is made. Now, the person who is receiving the offer can accept it, in which case he will be allotted the shares. Normally, General Contract Act, which you studied, Indian Contract Act, offer can be accepted only by the person to whom it is made. But in rights offer, there is a right to assign or transfer the right to someone else. This right is called the right of renunciation. We saw it earlier in DVS shares, differential voting right shares, when we were issuing, if I'm right, differential voting right. This guy said, I need, I also should get right of renunciation. No. I'm sorry, private placement. I'm sorry. When there is a private placement offer being made, private placement, okay, it's not an offer at all to begin with, as you know, it is only an invitation to treat, and it cannot be passed on. It will be given only the person to whom it is made can accept. Straight away, they made it very clear for private placement. There is no right of renunciation. But under 62, when a further issue of equity shares is made, whether by a public company or a private company, whether a listed company or unlisted company, law applies. you have to offer these shares to all the shareholders in proportion. But a shareholder who gets the offer has the right of renunciation. Means they can give up or renounce the right to subscribe for shares. Means he can transfer the right to buy to somebody else. The right itself can be transferred, right? Again, there's a point. Say, I'm one of the minority group. I'm a poor man, but I want to maintain the minority status there. Therefore, once I get the offer, I will pass on to my friend who will buy. So together we will continue to hold the same proportion. That is the purpose of these laws. But today, believe me, for listed companies, rights issue to my knowledge, it's more of a, companies need more funds, they go, they offer it. Okay, now. Where at any time a company proposes to increase its subscribed capital by the issue of further shares, such further shares shall be offered to the existing equity shareholders as nearly as circumstances admit, in proportion to the paid up share capital on those shares. Pro rata, in proportion. Such offer shall be made by a notice and shall remain open for a specified period, being not less than 15 days or such lesser number of days as may be prescribed, not exceeding 30 days. So maximum 30 days, 15 or less. Now, please note, the CG has been empowered by the Companies Amendment Act 2020 to prescribe a lesser period for accepting the rights offer. CG has accordingly prescribed 7 days. So, such lesser number of days as may be prescribed. So, using that power, because the section says as may be prescribed, there is no conflict. The section says as may be prescribed. Using that power, CG has prescribed 7 days by Rule 12A, which is effective from 1/4/21. So, 15 days in the Bare Act, 7 days is the rule. Rule is applicable because power to prescribe is available to the central bank. Right. Now, where 90% of the members of a private company consent in writing or by electronic mode, the offer may remain open for lesser periods than stated above. So 2 days, 3 days also you can do, provided 90% of the members of a private company consent in writing or by electronic mode. Right? Unless the articles provide otherwise, the offer shall deem to include a right of renunciation. So, point I'm learning here is, articles can provide otherwise. A company may say, there is no right of renunciation in the articles. So, remember in the examination, if they tell you the articles of the company provide that member shall not have a right of renunciation, company comes out with the right offer, then there is no right of renunciation because articles can provide otherwise. If the articles are silent, then the offer shall be deemed to include a right of renunciation. So, we already seen certitude, but see, rights offer shall be offered to the existing shareholders in proportion blah. Another option is to the employees under an ESOP. See, when I'm framing an ESOP scheme, employee stock option scheme, or employee stock purchase scheme, then there is an exception. I need not offer those shares to the existing shareholders because they are coming under a special scheme going to the equity shareholders. Or it can be offered to any persons for cash or consideration other than cash. See, main rule is it has to go only to the existing equity shareholders. Another option, I can give ESOPs. Lastly, I can allot these shares to any person for cash or for consideration, provided this is authorized by a special resolution. So, your existing members are there. You want to go for a further issue. You want to allot those shares to totally different person, not to the existing members. No problem. You go to the existing members and you inform them, boss, we are going for a further issue of 1 crore. We would like to allot this 1 crore to Mr. Donkey. Donkey is giving us some land or some IPR, or maybe he's investing money in our business. You guys are not capable of doing it, but this guy is going to give us. So kindly pass a special resolution authorizing me to do it. Instead of giving it to you fellows, I will give it to donkey. Can do. If the shareholders also say, yeah, correct. So long as some money is coming, please take it and improve the company and pay as dividend. So they will pass a special resolution authorizing the board to allot the further issue to any person, either for cash. Cash means money, not cash. Proper consideration, money instead of something, or consideration other than cash, right? Suppose it's consideration other than cash, then a registered valuer should prepare a valuation report, and based on that only you can allot to them. Now, what is ESOPs? It is defined in 237. ESOPs means the option given to directors, officers, or employees of a company or of its holding company or subsidiary company, which gives such directors, officers, or employees the benefit or right to purchase or to subscribe for the shares of the company at a future date at a predetermined price. See, I am an employee. As per this definition, directors are also included. Means the word directors is used to be non-whole-time directors also included here. Normally, ESOPs is meant only for employee directors. But the way this definition, but under SEBI guideline, you can give only to employees and employee directors. Directors who are not employees, you cannot. But anyway, point here is sweat equity shares are offered to specific directors or specific employees. Whereas here, you have to come out with a criteria. Number of years of service is usually the criteria. So you can say those who have worked for 10 years and above, 500 shares. Those who have worked for like that. Those who have just joined, nothing. 1 year completed, okay, 50 shares. Like that. So you decide. So anybody who has completed 1 year will be entitled to 50 shares. So all I have to do is I have to wait for 1 year. I can get 50 shares. Entitlement. Irrespective of who I am. If I complete 1 year, I'll get it. So that criteria will be there. Okay. So I get the right to purchase or subscribe for the shares of a company. Now, the company shares may be going at, say, 650 rupees. Now, the ESOP scheme may say, I will get it at 400 rupees. So I get 250 profits anyway. And I can buy it at any date. They will say, once you complete 1 year, within the vesting period, say 3 years, they'll give, you can choose. That's all. So the idea of this is a HR initiative to build employee loyalty. So once, think about it. Company shares are quoting every year, they're going up 300, and I'm getting a chance to buy it at a lower than the market price. Provided I complete 3 years or 4 years or 5 years, or depending. So I have an incentive now to work. And, if I work longer, I get more. Right? That's about it. Otherwise, there's nothing great about ESOPs. If you're a listed company, then SEBI guidelines are there, valuation and all that. That's all. Otherwise, there's nothing great about ESOPs. Right. This is rights issue. Now, whenever you make a further issue of shares, only these three options are available to you. Either proportionately to the existing shareholders, or ESOPs, or any other person, you get an authorization by special resolution. One more exception is there. See, where debentures and loans carry an option for conversion into shares, then nothing in this section shall apply to the increase of the subscribed capital of a company caused by the exercise of such an option, provided it is part of the terms attached to the debentures issued or loan raised by the company. Now, such terms should have been approved by a special resolution passed before the issue of debentures. See, you cannot issue the debentures and then put a conversion option. At the time or before the issue of the debentures, you should say, these debentures will be converted into shares or loan will be converted into shares. So those terms should be approved by a special resolution. Normally, no need. If you're issuing debentures, no need for any board can issue. But if you want to give them option of conversion, then you have to pass a special resolution before the issue of debentures. Once that conversion clause is there, then nothing in this section shall apply. Which means, though it is a further issue of share, it need not be offered to the existing shareholders. No need for special resolution. you can convert it directly. Provided the terms of issue have this option to convert, and those terms have been approved by special resolution passed before the issue of debentures or raising of the loan. It's a valid exception, right? Yes. Or issue or given a loan to you. Now, you keep servicing the loan, etc., but at one point in time you don't, or you have a dispute. Now the government decides, it may consider it necessary in the public interest that those debentures or loans or any part thereof should be converted into shares. Once the government decides and they justify it by saying because of public interest, then the government will pass a GO by which the shares will vest. This happened for, I think, Speak Limited in those days. The government they had the loan and all, they converted it and they got shares and all that. Now, something like that, there was a big dispute in Speak at that time. Now, here, there is no need for original terms, etc. This is irrespective of whether the original terms of issue had a clause for conversion option. So, for government, there is no need. Only for other than non-government loan, etc., debenture, the terms for conversion should be approved by a special resolution passed before the issue of the debentures. Then such government may give a direction for such conversion. Usually they will do it by way of a GO. Just compulsory conversion, how does it happen? So there's a direction for conversion. If it is acceptable to the company, yes, then don't go on appeal. Authorized capital shall stand automatically increased and the shares will be converted. The debentures or loan will be converted. Suppose you are not happy, the company does not want. Then in those days, your only option was go to the High Court against on a possible or even on a writ because the government is taking action. Now, no problem. If it's not acceptable to the company, for the conversion is not acceptable, then they can go on appeal to the tribunal within 60 days. The tribunal will hear the matter. Then they may allow the appeal. If so, then you don't have to convert. But if the appeal is dismissed, then straight away the conversion will happen and the authorized capital will stand increased to the value of the shares converted. You don't have to pass any special resolution for increasing that authorized capital. Automatically it will happen. In determining the terms and conditions of conversion, the government shall have due regard to the financial position of the company, the terms of issue of the debenture or loan, as the case may be, the rate of interest, and such other matters. See, what could happen is, according to the government, the company may be mismanaged or badly run. So the government will say, look here, you have borrowed from me, you are also not running properly. I will give me the company. In other words, I will allot shares for my loan and I will also become a director here. We will appoint an IAS officer and run the business. So as part of that, they will convert these shares into debentures and loans into shares. Okay. Let's see if another 2 minutes we can complete bonus shares because it's very easy. Issue of bonus shares is simply converting reserves into equity shares. A book entry. There is no inflow or outflow of funds. It increases the shareholding of the members. Okay. Usually bonus issue is in proportion. Like for example, 2:1. Like, okay. So if I'm holding 2 shares in Reliance Industries, I'll get 1 extra share, not 2. Normally Reliance, it will be like for every 20 shares, I'll get 1. Like that. Okay. So means the reserves will be converted into equity. And the entry will be general reserve debit, share capital credit. Okay. So according to section 123(5), dividend should be paid in cash. The one exception is the issue of bonus shares by capitalization of profits. So in a way, instead of giving a dividend in cash, they will give it by way of shares. Allotted. The advantage is, suppose it's a regularly traded share with a lot of market capitalization, the shares are a better gift than a dividend. In fact, some of these companies like Dividend, Reliance and Sundaram Finance and all that, I bought very few shares in 2002. Thereafter, these companies started issuing bonus shares and simply my existing shares started increasing. So that way bonus shares are liked by the investors. Obviously, it's free, inam hai na? Take it. Not inam. See, I am the owner of that company, okay, and that profit belongs to me. So instead of giving it to me in money by way of dividend, they are giving me shares to that extent. To that extent, they will convert it into share capital. Then I'll get further dividend on those new shares and also market price of those new shares. But normally rule, is when bonus shares are given, the price of the share in the market, listed company ka share will come down. After the issue of bonus shares, the market price will come down. Why? Because see, the market is driven by demand and supply. So when the company is doing well and people see it as a future, it will be doing even better, there is a demand for that company ka share. So people are willing to pay higher and higher prices. So when there is a demand, supply is limited now. Only so many shares are there. So supply is extremely limited, but demand is growing. More and more people want Tobacco Limited shares, right? So what happens? The price of Tobacco Limited will start going up. Pure sheer pushing. But when the bonus issue is made, what happens? Suddenly supply is dumped. So there's a glut. So there's a sudden supply demand. There's a supply side mismatch. So automatically what happens? All this demand will be satisfied and no more people come also, it will be available. So chances are the price will come down. But this is not a rule. There are some exceptions. When Reliance Industries comes out with a bonus issue or TCS comes out with a bonus issue, this rule may not apply. Why? Because there's a huge appetite for these shares. Huge appetite. So even if you dump more bonus shares into the system, people are there to take it up, buy it. So maybe for 2 to 3 days it will start hovering and then again it will start going up or stabilizing and going up. Okay. So that's only for top companies. If some stupid company tries this stunt, their price will go down. Because straight away, see, where I had 1 lakh shares, now suddenly I'm going to have 1,20,000 shares. So chances are it will come down. You can issue bonus shares out of free reserves, out of securities premium account. We saw that already. 5 matters for which security premium account can be used. One of the matter was bonus issue. And capital redemption reserve account. Yes, when you redeem the preference shares, you transfer the nominal value of the shares redeemed to the CRR. So you debited general reserve, you debited P&L account, and you credited CRR. That CRR is now part of your permanent capital. You cannot issue dividend out of it. It is not available for declaring dividend. But you can allot bonus shares. You can use it for issuing bonus shares. No bonus issue out of revaluation reserve. Where you create a revaluation reserve, you cannot use it for anything. Simply, it's a cosmetic number there. In fact, when you provide for depreciation, on the original value, historical cost, you will charge depreciation to the P&L. On the revalued portion, you will charge depreciation, but you won't take it to P&L, you will debit the revaluation reserve to the extent of annual depreciation. So that at the end of the remaining useful life, the value of the asset should come down. The revaluation reserve also should become nil. This many people don't know. Sorry to say this. Okay. Especially company secretaries don't know. They will say, sir, revaluation reserve is there. Let us allot bonus shares to the promoter. I say, Baba, you can't do it. No, sir, I can get opinion. You come and get 100 opinions. Read section 63 before you do that. You can't allot bonus shares out of revaluation reserve. Or any reserve which is notional profit. Can't. The exception is, suppose you are issuing, suppose you are having a sale of a capital asset. The profit is realized in money, cash. To that extent, you can declare dividend and you can also allot bonus shares. Though it is a capital transaction, the money is realized in cash and that belongs to the shareholders, right? So you can give it to them as dividend. You can also use it for allotting. But the profit should have been realized in money. It should not be notional. Simply you cannot increase the value of the asset, revaluation reserve, then allot bonus shares. No, not possible. It's a big pain. People keep on, they don't understand. See, the problem is, if you are a chartered accountant or an accounting background, you will understand why revaluation reserve cannot be touched. Because I need to charge depreciation, Baba. That asset has to go out. Every year I have to charge annual depreciation. On the historical cost, I'll take it to the P&L. On the increased portion that you have increased, where I'll take? That I have to take it only from this. The exception, of course, is land. Land, no depreciation. It will be lying there. The revaluation reserve will be there. But you cannot use it for declaring dividend. You cannot use it for allotting bonus shares. Not possible. Simply keep it in the balance sheet, look at it. That's a showcase. It's a cosmetic thing. You can't use it for any purpose. Sometimes company secretaries, I'm sorry to say company secretaries so bluntly because they are also my students. They will forget their accountancy lessons that I taught them. And I used to tell them again and again, they will forget all that. When the MD says, do something, I can't bring promoter's contribution. What to do? Immediately they'll say, sir, bonus, we can issue revalue the asset and issue. Board meeting, they'll come and talk all this bullshit. So we have to again tell them, Baba, it's not possible. Like that. Okay? So, good. So we already saw that, free reserves means which are available for distribution as dividend. Exception is security premium account and CRR. Not possible to declare dividend, but you can issue out of that also. See, section 63 is a new addition to the Companies Act 2013. You wouldn't find a comparable section in the old law. Why? Because old law, there was only one area where you will find some hint is dividend. They will say dividend should be declared only in cash. And then they will say provided that company may allot fully paid up bonus shares in lieu of dividend. So there is the only mention of bonus shares in the old law. Now they have got their own, bonus shares has got its own section 63, right? Yeah, the face value is a constant. Dividend is calculated only on the face value, right? Valuation, wow, see, I will do one type value for the same Infosys, I will do one valuation. Market will have different valuation. That's a bigger subject than today's topic. Please clear the intermediate exam, come to final finance. There we will, corporate finance, we will teach you valuation. At this point in time, it's too advanced. I mean, because you have the knowledge, please read Ashwath Damodaran on valuation. Okay. Thank you, Ms. Mandanjali. Thank you. Section 59, I think somewhere Ms. Neha Murarka is there. Anyway, I will take it up in the last because I need to complete the topics. That is why. Negaji, please understand my predicament. Allow me to take it at my own pace. Share capital remaining the same. The number and value of each share can be altered. Huh? No. Shares are, you saw the grid now. First day I showed you the grid equal. Each share is of equal value. Okay. Number can, see, you can acquire 50 shares. I can acquire 500 shares. But each share will be face value only 10 rupees, 1 rupee, whatever. You cannot change the value of the each share. No. Number of shares is. And when you are holding more shares, your control in the company will grow. That's all. No problem, Nehaji. I'm again and again telling you, I will answer your question on 59. But give me some time. That's all I'm asking you. Yeah. The right shares are offered by the company in proportion to the existing shareholding. Similar to bonus. See, it need not be 1:1. It may not be 1:1 also. Okay. For example, the recent example of rights issue is Reliance. The recent example of rights issue is Reliance. What I will do is I will give a small break at this stage because we are moving away from away from bonus issue. Okay, quickly I'll finish it. There should be an authorization in articles, ordinary resolution in general meeting on recommendation by board. No default in repayment of principal and interest on FD and debt security. So you can't keep that fellow pending and you allot yourself bonus shares. No. So there should be no default in repayment of principal and interest on fixed deposits and debt securities like debenture, bond and all. No default in payment of statutory dues of employees. Partly paid up shares to be made fully paid up. So partly paid shares, you cannot issue bonus shares. It should be fully paid. Compliance with Rule 14, that is, once announced, bonus issue cannot be withdrawn. Okay? Rule 14 says, once announced, bonus issue cannot be withdrawn by the board. The bonus issue not to be issued in lieu of dividend. That is, in a year, you cannot say, we are declaring 20% dividend, but we won't pay in cash, we will give it to you in shares. No. You have to, if you are declaring dividend, pay that. In addition to that, you can allot bonus shares also. Right. So with this, I will give you a small break, say 5 to maximum 7 minutes. Thank you, Tanhaji, for that suddenly good word. See, Prema Joy Clara, your question will not be answered. Sir, please explain about rights issue. Madam, that is what I was doing for so long. This is a class which has restrictions on time. So kindly, there are two options you got, Premaji. One, you can ask a specific question in this topic where you are not understanding. Or simple, this video, this lecture is being videotaped. You just to go back later, download the video and watch this portion alone. Still, if there is a doubt, kindly raise a doubt in the next class. Please do not ask me to explain rights again. We don't have the time for that. Please understand. Okay. While I appreciate your need to understand, Premaji, please you also understand my need, my inability to oblige. I cannot go through all these slides again without knowing which part you have not understood. Basically, I can tell you one thing. Whenever further issue of shares are made, those shares shall be offered to the existing equity shareholders in proportion to their existing shareholding. Normally, prospectus is an invitation treat. The application is the offer. Here, the company makes an offer. The shareholder accepts it. And right of renunciation means the person to whom the offer is made, rights offer, he need not accept it. He can renounce the right in favor of somebody else. Right? Unless the articles provide otherwise, the offer shall be deemed included. Now, suppose you are going for an ESOP, then you need not offer it. That ESOP part, you need not bother about the existing shareholders. Directly go for ESOP. Or you want to allot the shares to any person, and that is, you want to go outside of 62, then you can do that provided you pass on special resolution. Okay. So I'll tell you where the problem is. The old section 81, which dealt with this topic, was a beautiful section. It talked about the first part, existing equity shareholders, and then it gave a proviso by which it said you can allot it to anybody else, provided you pass a special resolution and all that. Somewhere these people have brought everything into one blot, and maybe that is the reason for confusion. So if I'm going for further issue, first option, I have to give it to the existing shareholders in proportion. If I'm going for an ESOP, then I can tell the existing shareholders, sorry, this is ESOP only for employees, allowed. Thirdly, I want to allot to other than the existing. Then I have to call the existing shareholders for a meeting, get them to pass a special resolution, get it, if it's for consideration other than cash, get it valued, and then I can allot to anybody else. Got it? Another point is also there. See, I'm giving them time now, 15 days, 7 days, even whatever. Within that 7 days, if these guys don't apply, for 7 days I wait, or whatever time I wait, up to 30 days. Nobody is applying. Then I can do anything I want with those shares. Because they're not applying, Beyond 30 days, the shares are open. Then I can allot. Okay. That is also possible. So, to an extent, I have obliged my friend Premaji, but the entire topic cannot be covered again. Right? Principle I have told you. Go through my lecture again. Maybe. But students should also learn the art of asking specific questions rather than repeat the topic again type. For which you don't have to do anything. Institute is providing a great facility to you. You can download this video freely and watch Srikanth any number of times. Repeat. I'll repeat it for you. How? Go back, again come back. You'll see me again telling the same story again. Okay? Use that facility. Good job. We are having a small break. Time now is, for my timing, it is 8:45. So 8:55 upper limit. I will try to be back before that. Okay? When we will take up the next topic and move on. Sir, break, sir. Ram, break. Thank you. Welcome back from your break. And to take up the question raised by Ms. Neha Murabas, I'm not a shareholder, so I see where am I? I'm not even holding shares. So I don't have physical certificate security or an entry in the deposit. But the other way is possible now. I am an existing shareholder, but my name has been omitted from the register, which means I'm an existing holder of shares. This is what 59.3 talks about. The provisions of this section shall not restrict the right of a holder of securities to transfer such securities. So I am an existing shareholder. My name was in the register. You removed it, but I am still a holder of shares. Yeah. So my right to transfer is not lost, and any person acquiring such security shall be entitled to voting rights, unless the voting rights have been. So this is the sum and substance of 59.3. I am an existing shareholder. They distinguish between shareholder and member. Member ka naam register of members may have, but shareholder may not be there. But I am the register. I am a shareholder. Yeah, I got those shares in my DP account. You can't take that away from me. So I can sell it, and the guy who acquires it can vote, unless you see there are other sections in the Companies Act where, for many reasons, we will go to the tribunal, and the tribunal will pass an order saying, for these shares cannot be transferred. Suspension of transfer will be suspended, or voting rights will be suspended. In which case, even if the shares are transferred, see, I am the existing holder now. You cannot prevent me from transferring, but voting rights can be suspended for those shares. You will come across it later when you come to investigation and all that. You will see how they will restrict the voting rights now. Where there's a fraud, where there's some issue, only then they will do it. Suppose Mr. A has been doing some fraud and he is mismanaging the company. Then one of the things that tribunal can do is they can suspend the voting rights. Okay, that's an advanced topic. But when such suspension has happened there, then even though the shares are freely transferable, voting rights cannot be exercised. But if such suspension is not there, then this section cannot restrict the right of an existing holder of the share from transferring it. And the transferee will be entitled to vote. Okay. Of course, he will make this application, get his name reinstated in the member. That is the whole point of section 59. In my humble view, where a person's name is wrongly entered in the register when he is not a shareholder, 59.3 will not apply to him because he is not even holding shares here. His name will be removed. That's all. The tribunal will order direct. One of the tribunal's power is to direct that the register of records. Okay. I hope you are now clarified. I thank you for pointing out this point. I will add 59.3 to this notes. See, no problem. So thank you very much for that, Ms. Neha, and do confirm if you have understood what I said on 59.3. Now there are some doubts that students are asking, which is interesting. Let us see. What will be the voting rights of the members as this section is related to? That's what I'm saying. See, once every share will carry a voting right, right? Because my name has been omitted, doesn't mean I cannot transfer those shares. Once I transfer, the new guy can, there's a general meeting, the new guy will come and vote. And that cannot be restricted by 59.3. Is the point. Is my understanding. Though this section does not deal with voting rights, they talk about it in passing. All they are saying is an existing holder, you read the entire subsection, you will understand. The existing holder of equity shares, this section, the provisions of this section shall not restrict the right of a holder of shares to transfer such securities. Okay. And any person acquiring such security shall be entitled to voting rights thereon, unless the voting rights have been suspended. So, basically about transfer, so once 59 proceedings are going on, a person who is the holder of shares whose name is omitted in the register doesn't mean he has to keep quiet. He can transfer. The guy acquiring it can get it. Okay? He can exercise voting rights also. Right? Because those shares are real shares, na? Right? See, all this will happen when there's a lot of dispute between the shareholders, or when there's a, mainly this 59 will be used mainly for takeover code. When there's an adverse takeover of a company, now all this will happen, right? Where the board of directors will be controlling the company, promoter group, a raider will come, he will acquire 30% stake, then he, along with this group, not individually, along with this group, then these people will remove them, not allow them to vote, all that sort of nonsense will happen. So they will go to under 59 for rectification of register and say, my name has to be entered. I have purchased these shares. Company is not including it in there. Please ask them to include it. Or they can even say, so-and-so's name is there. I have acquired it. Remove his name and put my name there. Whatever it is. In those circumstances, shares can still be transferred and the transferee will get the voting rights. That is what it is. So I understand that you put it 2 times, not because of your thing, but just joking. Don't take it seriously. Thank you. And I hope you are now cleared, Nehaji. Okay. Now let us see some more questions. Share capital remain. Pooja. Share capital remaining same. The number and value of each share can be altered. Yeah, that is one. But suppose I'm subdividing, then the value of one share will change. Share capital is same. But suppose I'm increasing the other is capital, then capital amount itself will go up. Suppose I'm cancelling shares, then the capital amount itself will come down. Whereas the individual share value will remain the same. So don't confuse on that point. Don't get unnecessarily confused. Yeah, transfer of the right is called right of renunciation. Absolutely correct. See, when Reliance Industries in 2020, Reliance Industries went for a rights issue. Rights issue, partly paid shares. Rights issue, partly paid shares. They went for a rights issue. Obviously, when the rights are given, what happens now? The right price, I wanted to show that. I'll just show you that. I'll just show you that and then you will understand better. It's interesting. This is when the Reliance Industries Limited rights came, I was one of the shareholders, so I got this offer. Along with the offer, I got the application process also. So, point I want you to understand is the issue price. For the rights, the price was 1,257 per rights equity share. And I got one right equity share for every 15 shares. So, if I am holding 15 shares, I get one. Proportion. So, for every 15, I get one. Obviously, they can't give you 1:1 because the price of the value. At the time when they made this rights offer at 1,257 rupees, the price of Reliance share was going at 1,453. Right. So, I have two options. I can buy it at 1,257 and hold it. That would have been a better option. But foolishly, I did something else. What I did was, see, at that time, the shares are quoted at 1,453. So, we did a calculation and we found that if I buy it now, if I sell the rights were at that time quoted at 356 rupees. 356 rights were traded. Only for that short 10-day period, the rights were traded. Now my right had a value of 356 rupees. There is something like that. Right. So, what I 350. How that was determined now? The difference between the market price and the rights offer price. Based on that, the rights value will keep changing. So, if the market price keeps coming down, the rights value will keep coming down. The market price keeps going up, the rights value will keep going up. How that is calculated, you will learn in finance. Not a problem. Point is, the rights has a value. Also, I can renounce it. So, what I did was, I renounced my right shares. What I did, I renounced my right shares. I got 360 rupees something. Then on the same day, I purchased Reliance shares at 1,453. Now my price is not 1,453. It is 1,453 minus 300 or not, which came to 1,001. So there was a small profit there by doing this. So I sold my right in Reliance. Reliance rights I sold. I didn't buy that share at 1,000 rupees. Whereas, according to me, I was wrong. Sometimes everybody can be wrong. And I'm happy to say I was wrong. I learned a lesson that I should have actually purchased the 1,257. Today, 1,000 to 2,700. What I should have done, like a fool, what I did, when the share price went to 1,900, I sold it. That I should not have done. But I made a good, neat profit on that. I had a lower than the rights price, I got it. 1,453 minus rights value I got a purchase price which is less than the rights price. Fantastic. What I should have done, kept my mouth shut and not sold it. But after 3 months, when the price went up to 1,900, nearing 1,800, I sold it. Wrong, mistake. I should not have. See, the lessons we learn, how many times we learn, we forget. Reliance share is worth gold, worth a diamond. I should have simply kept quiet, hold it. Or a better thing would have been to go for the partly paid shares. Instead of, see, suppose I had applied for these shares, I would have had to pay only 314 rupees 25 paisa. The balance I'll pay only in May 21 and the balance 628.50 in November 21. So I don't think they even made those calls yet. To my knowledge, they have not made those calls. So, and the beauty was, I was thinking, if I buy the partly paid shares, I cannot sell it if I want. Something, see, but you know what? Reliance partly paid share is now quoted in the market. Partly paid shares of Reliance, these right shares which are partly paid shares are quoted in the market. Available, you can buy and sell partly paid share. Anyway, so for your information, I'm just telling this to you. This is in 2020, Reliance came out with a rights offer. That's a nice example I thought I would share with you to help you to understand this concept. Rights. So this would have answered some of your questions, let us hope. Means rights issue are offered by company in proportion to the existing holding. In proportion. So how many ever shares are holding in proportion? Say 15 shares I'm holding, I got 1 share. So it won't be always 2:1. Depends on the share. They will do the valuation then. Say they see what is the valuation. Then they'll decide how much to give. Right. Okay. That is one good thing, sir. Mr. Mahendra Bhai Charadwa. Respected, sir. Thank you. Does it make any significant move? The amount in share capital increases and reserves. See, in the balance sheet, it is book entry. In the balance sheet, it is only a book entry. Agreed. But if it is a listed company, then for the shareholder, there is a big benefit. Because this, see, what is there in the reserves, he can do nothing. It's in the balance sheet. But once the bonus issue is allotted, he gets the share in his hand. He can convert it into money by selling in the market. This is mainly for listed companies. You can immediately sell it in the market, which is why the share price will come down. Because all these guys who get the bonus shares, they might go and sell the bonus shares. In which case, because of the sudden supply side increase, the price will come down. But only for the shareholder. For the company, it is only book entry. Bonus issue 2:1 means 2 bonus share for 1 held. No. 2:1 means, see here. Members holding 2 will get 1. If you think it is like that, then you should say 1:2. You will get 1 bonus share for every 2. Okay. If you want to give 2 bonus shares for 1, you should give 1:2. Depends. Okay. 2:1 means members holding 2 equity shares will get 1 fully paid up bonus share. Okay. For every 2 shares in the company, you will get 1 share. So if you want to give 1:2, then for every 1 share, you will get 2. If that is your intention, then that's how you should mention. So I have checked it. Right? Thank you for guiding me, Nalini. Number of shares and value don't change. Pooja, please do a recheck on your knowledge of alteration. Go to that slide later when I give it to you. Sometimes there will be increase in share capital, but no increase in individual price of the share, face value. Number of shares and value will go up, but individual will remain. Sometimes in subdivision and consolidation, the total will remain the same, but the per share value will come down or go up. So it depends on what you are doing. Okay. No, you can't transfer. See, when the rights issue is open, only for that short period, instead of applying for the share, you can transfer the right. Only during that period. Once you have applied, they become normal shares, which will be allotted to you. You can sell them normally. That is not renunciation. During the rights offer, when the offer is open, you will get the right, you will get the option that, see, in the menu itself, it will come. You can sell the right also. It will be traded on national stock exchange. Continuously, the right value will keep going up and down. Depending again on demand, yeah. See, Reliance and all, people want to hold that share. Now, here's an opportunity. So they will bid for the rights. And the maximum is, it cannot be going beyond the difference between the market price and the current price of that share. Correct. So that it will hover in that range. But sometimes, because of Reliance charm, they might say, no problem, yeah, I'll get it. It's an opportunity to get more Reliance share. I will get it. Okay. Now, this happened in the Reliance case. You can check it out. Others also may come. If any rights issue comes, they can dispose it in the market. The right will be quoted, but only for the limited period. 10 days, 7 days, 5 days, 15 days, maximum 30 days. Only for that period you can sell it, the right. Once the rights offer time is over, either you have applied or renounced. If you have done neither, go, that's all. What else you can do? You should have either purchased the shares by applying, or you should have renounced and got the money for the right. Neither has been done, 30 days over, 15 days over, then simply watch the fun from the side. That's all. Nobody, you are out of the game now. That's all. See, again, Rupesh Bhimani is another gentleman who is putting up a comment like this. Paid shares offer price. What is that? Paid shares offer price. Seriously, I'm not able to decipher the meaning of this cryptic comment. Kindly elaborate, sir, in normal English so that I can understand what you are asking. Not even a question mark. It's a statement. Okay, paid shares offer price. Thank you. So, I know I'm sounding a little irritating to you, but think about it, Rupeshji. What will an uneducated man like me understand from what you have said? Paid shares offer price. What I understand? What do you want? Paid shares offer price. What do you mean by that? Please, I know I may be equally unintelligible to you, but I am trying my best to make myself make myself understood by you all, right? You should also take the same effort for me now. So write some fluent English where, grammatically, so that I can understand what you are asking. Otherwise, how can I answer? I'm not God, that from this I have to understand what you want and I have to guess. We'll be wasting not your time or my time, but the time of the other students. Okay, Ji? So whenever there's an alteration of share capital, right? Under 61, or government gives a direction under 62(4). You remember? Conversion of loan or debenture by the government compulsorily. Then the authorized capital automatically go up, right? We saw that. A company redeems any redeemable preference shares. What happens? The paid up preference capital will come down, right? Then such company shall file a notice in form SH7 with the registrar within a period of 30 days of such alteration or increase or redemption. So whatever type of alteration you are doing, or whenever the government gives a direction and the company redeems any redeemable preference shares, you have to file a notice in form SH7 with the registrar within a period of 30 days of such alteration or increase or redemption as the case may be, along with a copy of the altered memorandum, right? In case you don't do this, in case you don't comply with 64, then penalty, company 500 rupees, continuing offense, 500 rupees for each day during which such default continues, subject to a maximum of 5 lakh rupees. There's a fine of 500 rupees for each day during which such default continues, subject to a maximum of 1 lakh rupees, right? Now we go on to another very interesting topic, which is reduction of capital. We saw that now when we spoke about cancellation or diminution, I spoke about reducing. Basic difference. Cancellation or diminution is unissued capital. We are only bringing the authorized capital down. Reduction we are bringing the paid up capital down. In 61 ka alteration, diminution, cancellation, I am only bringing the authorized capital down. Right? These are unissued shares. Unissued, unsubscribed, unpaid up, not paid up. Whereas in reduction, I am reducing the capital. The paid up capital is coming down. Right. Now, I'm going to ask you a question. Rupesh, I'm sure you are a brilliant person. You passed the Nifty Swift 95 and all. But still, your question needs to be clarified to me. Please understand, you are a brilliant man. I am a Buddhu. I totally agree with you. Kindly clarify the question is what I am asking, Rupesh ji. Why are you getting angry with me? Don't get angry. Still, I don't understand paid shares over. I'm sure you are brilliant in share market. I'm not questioning your knowledge at all. Okay. And I'm still learning. Okay. Every day I'm learning. But kindly clarify your question. That's all I'm asking. Don't get angry with me. Okay. Oh, two shares. Okay. If you think that is correct, I'll agree with you, sir. 2 bonus shares, 1 share. So 2:1 means 2 bonus shares, 1 share held. Okay, ma. I have learned. Thank you, Rupesh. 2:1 means members holding 2 equity shares. 1 equity share will get 2. Right? 1:2 means members holding 1 whatever. Okay. So you are happy now? No. Whatever. If you are happy, I am not unhappy, Rupesh. But you still again see company seal, debenture holder collateral, all you are giving only. See, I'll tell you where you are. I'm sure you are a brilliant person. You are a Nifty Swift 95, whatever that means, because I'm unable to understand it. From you are a NIIT certified, whatever. Boss, salute you. Pronouns to you. But the point is, CA exam, you have to write a little more in full words. If you think I am your teacher and you are a student at this stage, if you still consider yourself to be a student, then please listen to me as a teacher then. But if you think you know everything, then chalo yaar, I will learn from you and I will become student, you become my teacher. But a teacher should talk fluently and give clarity. Okay. So see, like Pooja is putting so many questions. See how elaborately she is asking. Then I am able to understand what she is asking. Neha Murarka. See how they are elaborately asking questions. Such elaborately, if you write, it will be good. So really salute you for your great knowledge of capital markets. You also should become a company secretary. You may be, because capital markets is specialization for company secretary. Since you already have so much knowledge, you should become a company secretary. Mukta, yeah, sir is selling, right? I hope I explained that to you, no, Mukta ji. Good. Good show. Fantastic. Now coming to reduction of capital. So Rupesh, this topic comes to an end. I totally agree with you on your view on bonus shares. I'm not going to waste your time because that has nothing to do with the examination. How it is worded and all is not relevant for all that people need to understand is it will be in proportion. So if I'm holding 1 share, I may get, if I'm holding 2 shares, I may get 1 bonus share like that. Okay. That will be clearly mentioned. See, Visana, how Reliance, they have clearly mentioned it now. So like that, they will clearly mention. So not a problem. At least they will clearly mention what they are talking about. Okay. When capital may be reduced. When capital is not represented by assets. Now I will come to another question to you. I'm going to ask a question as not law related, but accounting related, where possibly you are all authority, I am nobody. Okay. All I am asking you is this question. All I am asking you is this question. When will share capital account be debited? See, not share capital is appearing on the liability side of the balance sheet. So it is the owner's capital and therefore a liability for the business, blah, blah, blah. It's true, you're all experts. So share capital always be credited, right? What are those circumstances when, very rarely, but it will be done when paid up equity share capital account, equity share capital or share capital account will be debited. There are many situations. Let us see how many you are able to get. You just keep putting it in the Free reserves, definition I showed you now. This is what free reserve means. Such reserves which as per the latest audited balance sheet of a company are available for distribution as dividend. So P&L account, general reserve, you can use for dividend, right? Dividend equalization reserve, any reserve which is available for declaring distribution as dividend. So obviously capital redemption reserve not available, securities premium account not available, SEZ reinvestment reserve account not available because it is specifically earmarked for reinvestment in the reserve, like that. So where it is not available for dividend, it is not a free reserve. Beautiful, I'm getting so many answers. Correct. Forfeiture of shares, absolutely correct. Absolutely correct. Reduce, when the capital is reduced, that's what one more occasionally we are seeing. See, you will learn this in accountancy as capital restructuring. Means, or reorganization, or you will see this in final exam also, where the compromises arrangements, where a company will be doing so much loss that its capital is eroded now. So the balance sheet is stupid here because the capital is there, but to that extent assets are not there. Capital is not represented by assets. Instead you have loss. So you have made losses. So those cases the capital is not truly represented by assets. I can reverse it by reducing. But I cannot just pass a book entry and reduce it. Yeah, that book entry needs to be sanctioned by the government. There's a long-winded, elaborate procedure for reduction, which we are going to see now. Okay, got it? So, cancelling, we will not debit share capital because authorized capital we never credited. Yeah, it is only a figure appearing in the balance sheet. Only paid up capital I credited. That I will reverse it. And in cancellation, there will be no debit to capital. But reduction of capital, debit share capital, credit capital reduction account or capital restructuring account. You'll accumulate all this in the capital restructuring account and finally debit capital restructuring account and credit loss. That all that accumulated loss will be there in the reserves and surplus negative item that you will reverse it so that your balance sheet will look neat. Once you go for reduction, the capital will also be reduced. Loss will also go out of your books so that you can start your life again and start. So this is called reduction of capital. This is one example where heavy losses are there in the balance sheet, accumulated losses. So capital is not represented. I can reverse it. Okay. Yes. Beautiful. A lot of examples are coming out. Share capital account will be debited. All of you are giving a forfeiture, which is absolutely correct. One of the examples. Redemption of preference shares. Yes. Buyback of shares. Absolutely correct. We'll be seeing buyback maybe in this class or next class. Buyback. Like that. Buyback. Reduction of capital. Winding up. At last, Rekha gives me the one answer. At the time of winding up, yes, I will debit share capital, credit shareholders and pay. That is the last entry I'll pass. Means almost last entry I'll pass. After that, no company. When money is given to the shareholders, end of story. At that time, I will again. Very good. Very good. So, excellent. Beautiful. Thank you. So, we'll quickly see reduction of capital and then possibly I will close. Just bear with me for another 5 to 10 minutes. I will close it. Now, one example was when there is a loss and capital is not represented by assets. Another example, return of capital in excess of want, over capitalization. What happened was our friends decided to go for one big project. So they went for a big public issue and money was also given to them. And they want to go to some other project. Nobody is allowing them to do it. You know, they have to pass a resolution on 3/4 and all that, not allowed. So these fellows said, Chalo, you don't want us to do what we want. We are not willing to do what we propose to do. Take your money back. Excess of want. I credited capital now. Now I'll debit capital and return it back. This is one way. Another way is, see, there was this classic example of there's a company called None Such Tea Company. None Such Tea in the Nilgiris. In Tamil Nadu, there's a place called Kunur, Uttakaman, Kunur, which is in Nilgiris. There's a tea estate. None Such Tea. See, this tea estate, what they did, they had 5 or 6 estates. they sold one of those, say one or two of those estates and got a huge amount, capital gain. Now see, obviously to that extent the money is there in excess of want because their estate did not need so much money. So they decided to give it back. So they reduced the capital and repaid the money to the shareholders. So they said, everybody who gave me 10 rupees share capital, here take 9 rupees. I just keep 1 rupee, show you as fully paid up, and go on with that. So that is also a case. This is number one is the case of poverty or not having money, losses. Number two is the case of plenty, where the guy has got more, take it back. Okay, but both are example of capital reduction. In both cases, the debit will be share capital, credit capital restructuring account, then debit capital restructuring to bank, like that. Or debit share capital, credit equity shareholders account also you can process. When it is in excess of want, straight away you debit share capital, credit equity shareholder to the extent of the amount to be refunded to them, then pay them. Equity shareholders account data to bank close. But when you are writing off losses with capital, now you have to first operate capital reduction account, and that will be used for it. So at that time, there will be a reconstruction or there will be a compromise or an arrangement with the shareholders. Because initially what these buggers will do, the management, they will go to the creditors, the bank, secured creditors, and I'll tell them, we have made losses, man, kindly help us, waive off the interest, reduce the capital, reduce the loan and all. The creditors will have a meeting and they'll say, chalo, we will approve this. We will take a haircut. But what are you guys going to do? So you guys also, your capital also, you reduce it. You invested 10 bucks now, take 9 out. 9 is gone. So your capital now become 1 rupee. In case the company is going for winding up, you will get only 1 rupee back, not 10 rupees. Reduce your capital. So as part of that scheme, they will say this also will come. But reduction, you cannot do it casually. You have to get the approval of the tribunal. And reduction is not permitted if the company is in arrears in the repayment of any deposits accepted by it or interest payable. So they say whatever happens, repay the deposits, pay the interest on it up to date, and then go for reduction. How capital may be reduced? 1. By extinguishing or reducing the liability on any of its shares in respect of the share capital not paid up. See, for example, take Reliance share itself. There is still some portion not paid up, 321 rupees. Reliance can say, don't pay. We will take it as fully paid up, this amount. It's also possible. Either with or without extinguishing or reducing liability on any of its shares, cancelling any paid up share capital which is lost or is unrepresented by available assets, or pay off any paid up share capital which is in excess of the wants of the company. So here they use the word cancelling, unfortunately, but this cancelling is not the same as cancelling authorized capital. Right? This is cancelling paid up share capital, reducing, which is lost or is unrepresented by available assets. Also, pay off any paid up share capital which is in excess of wants. Pay, literally give the money out. Okay, in all cases, you have to alter the memorandum by reducing the share capital or the number of its shares accordingly. So you have to pass a special resolution. You have to go to the tribunal for confirmation. And before passing a favorable order, the tribunal should give a notice of the application to the central government, to the registrar, to SEBI, to the creditors, especially creditors. Any one of them can come and give an objection. Right? Creditors will include income tax department, GST also. So all of them can give an objection. And in what can happen is, there is a notice by tribunal to stakeholders. Means everybody who is involved. Shareholder, debtor, banker, creditors. Sorry, not debtors. Creditors, vendors, everybody. Then the representation may be received from them. Why this should not be done or what are the problems. This representation should be given within 3 months of date of receipt. If no representation is received within 3 months, then presumption is that there is no objection. No, you are just keeping quiet, nothing. But if representation is received within 3 months, then that will be taken into account by the tribunal. Okay. Now, in addition to these statutory bodies, tribunal will also give a notice to stakeholders, including investor associations. If there is a listed company, then investor associations will get it. So they may also make a comment. They will also ensure that the debt or claim of every creditor of the company has been discharged or determined or secured or consent has been obtained. See, he is a creditor. He is having objection. He is not agreeing to the reduction. Then pay him off. Discharge it. Or you determine it. You tell him, boss, this is what it is. And see, here is an asset. In case anything happens, you use that asset for your loan. Like that. Determine him. Or as I said, secure him. Show him an asset and take it. Or take his consent. That's all. You go file a dispute and say, Baba, do something. Give your consent. But unless there is a consent from every creditor or no objection, sorry, reduction cannot go on. Before making an order of confirming the reduction of capital upon such terms and conditions as it deems fit. Okay. So before confirming, the tribunal shall pass such terms and conditions. Now, what could happen is a particular creditor could be cantankerous, simply delaying the whole process because maybe the reduction of capital is in the interest of everybody. So the tribunal will say to the creditor, look here, we will determine your amount. This amount is payable to you and the company will give you a bond or indemnity or whatever and see to it that they pay it to you. Okay, don't worry. Go. Something specified in section 133, which is why I sort of kept on dealing with the accounting part again and again. Okay. In fact, one engineer was using Zoho books and preparing accounts. And in the balance sheet, share capital appearing on the asset side, debited share capital. So I was shocked. My people have come on, share capital, debit, how? And that too staying there. See, that's why, we know only these cases it can go, then it will go out of the books. So already credited, go out. Now share capital is appearing on the debit side. So I called that lady, she's an engineer, and I asked her, what is this, madam? No, sir, Zoho books is so easy. Non-accountants can also use. Accounting is now no longer needed. We engineers ourselves can prepare accounts and all. Correct, madam, but how share capital is in debit? Then she said, sir, what sir, you are a chartered accountant, you don't know? Debit what comes in, credit what goes out. Share capital came in, so I debited. This is the problem. Okay, next thing I will become doctor, you become advocate, engineer will become a chartered accountant. That's all. That is a fantastic way of ensuring that the world will go to the dogs. All of us are specialists in one area. Definitely, I will not presume to build a bridge or construct a building. I will not presume because I do not have the knowledge. But engineers will presume to know accounting, what to do because of Zoho books. Chalo, debit share capital. Because capital comes in the way. So, no problem. Reduction is not permitted if the company is in arrears. Yeah, see, if you want to reduce your capital, first you have to repay the deposits together with the interest. Is that the point you wanted to elaborate? Yes. The reduction is not permitted. It's prohibited. You can't. If you are a company which has issued you accepted deposits, you have not repaid the deposit, then you cannot reduce your capital unless you have paid. It's in arrears. So don't be in arrears. You pay them, repay the deposit, pay the interest, no longer in arrears. Now go for reduction. Hope they have clarified. In case you have got that clarified, kindly put it up so that I will know that I have clarified your point. Okay. Accounting standards. So order of tribunal should be obtained for confirming the reduction. And it should be published by the company, okay, in such manner as the tribunal may direct so that everybody will know, public notice. Then a copy of the order confirming the reduction should be delivered to the registrar for registration within 30 days, together with the minute. The tribunal will give you a minute, means a noting, memo, that should be filed, showing the amount of share capital, number of shares into which it is to be divided, the amount of each share, the new capital, and the amount, if any, at the date of registration deemed to be paid up. Now the registrar shall register the same and issue a certificate. The confirmation is complete only if the registrar registers the same and issues a certificate. So this 30 days is very, very important. Once you get the order, the company secretary or the lawyer gives you the order, From the date of receipt of the order, within 30 days, you have to file with the registrar. Otherwise, the whole exercise is meaningless. Which is why all company secretaries, their job will be over only when they obtain that certificate from the registrar. Till then, his job is not over. In case, some creditors, because of reduction of capital, there is a reduction of members' liability. Correct? Especially if it's a partly paid shares, this will be relevant only for partly paid shares. Suppose partly paid shares are there and I'm reducing the liability. See, I'm extinguishing the liability here. See that? Extinguishing or reducing the liability of any of its shares. When partly paid shares, they are reducing or extinguishing the liability, then who is affected? The creditor. Am I correct? Okay. So, in case there is a reduction in liability, that's only for partly paid. Fully paid shares, there is no question of reduction of liability. Capital which has been poured in will be lost. That's all. Keep this in mind while understanding this provision. This provision will apply only for partly paid shares, where we are reducing the liability. Nothing wrong, but a creditor is affected. So we prepared a list of creditors. We convinced the creditors. They have given no objection or they have been secured or something. But one creditor who is entitled to object, his debtor claim was not entered in the list of creditors. And due to his ignorance of proceedings, he didn't object at that time. But after the reduction, the company defaults in settling his debtor claim. Please understand. At the time of reduction of capital, public announcement was made, creditors list was given, but our man's name was not entered. Due to his ignorance of the proceedings itself, due to so many reasons, or he might be aware of the reduction, but not aware of the effect of the reduction on him, that now the member's liability is reduced to contribute towards his debt. Nothing wrong if the company pays all the debts in full at the time of winding up. But suppose after the reduction, the company defaults in settling his debtor claim. Then every member, as on the date of registration of tribunal's order, please note, as on the date of registration. Now do you see the reason? Registration date is very, very important. As on the date of registration of tribunal's order, which day? On the day of registration. Before the reduction of, he was in corona pandemic, he was during exact that period, he was in trauma and he was in isolation, whatever. Some proof you give. Then tribunal may settle a list of contributories. Means they will say, this fellow's debt alone. Today's contributory, no. We will go back to that day, registration day. See who are all liable. They have to contribute. And that they will have to contribute to this creditor. So the learning I've got getting from this provision is, we should take extra care in finalizing the list of creditors for reduction proceedings. Which is why when the list of creditors being prepared, we take 100%. In fact, we should see to it that the list is 100% correct. Okay. Right? The above provision shall not affect the rights of the contributories inter se. Means, suppose one contributory pays, another fellow does not, the guy who has paid can collect from the others who have not paid. Okay? Proportionately. Right? Nothing in this section shall apply to buyback. Buyback is an exception to reduction of capital. If you go through section 68 provisions and you comply with it, then no need to comply with 66. 68 is an exception to 66. We'll be seeing 68 in the next class, right? So the time now is something like 9:40. So I will not extend the class further. Some more one more line. Every officer of the company who knowingly conceals the name of any creditor or knowingly misrepresents the amount of debt or abets or he is privy to such concealment. Abets means he supports it or he is aware of it, keeps quiet, or he misrepresents it, then he shall be liable under section 447, fraud, 10 times and all that stuff, imprisonment. Okay. This is to prevent officers of the company, including director, whole-time director, to conceal the name of a creditor and thereby prejudice. Right. In the next class, we will start with prohibition on purchase by a company of its own shares, go on to buyback, and then debentures. With that, this topic should be over. Next class, I will upload the PDF. I will also put up the assignment. I will also give the answers for the earlier tools. Thank you for your patient support. Let's see if any quick questions are there. It's reduce of share capital. Can a company without approval? No, sir. With approval only it can be done. 66. Either you comply with 66 or with 68. 66 or 68. One of them. Today, because a single share can be transferred on the dematerialized form, fractional shares are not there. There's no question of fraction. But sometimes when you divide, you might get a fraction, in which case that amount alone will be paid as cash. SEBI will authorize the company when there's a fraction. See, when I'm dividing and I'm having, say, odd number of shares, when I'm dividing by 15, there will be a fraction. No, that amount alone, that portion alone can be paid by way of bank transfer. The balance shares will be allotted. Yes. Free reserves for the current year profit also included. I mean, opening fee, yeah, correct. P&L ka balance is there. Nga. Opening balance, all adjustments, closing balance, current year. P&L balance is included. Okay. Current year profit also included. See, what you need to see is P&L ka balance in the balance sheet, which will include current year profit also. Na. When we receive any excess amount of shares then required, then we debit the share capital to reduce the amount. Not clear. How you will receive excess amount? I don't understand. It's reduce of share capital. Can a company without no approval of NCLT is needed? In case of company wants to change their objectives. No. That at that time we won't debit. We will buy back. Yeah, in a way, yeah, we will buy back the shares. Correct. We will buy back the shares. To that extent, we will debit. Yeah, whenever there's a buyback, we will debit. Sir, I'm not aware whether a reduction has happened. There are many hundreds of cases of reduction have happened regularly. Reduction of capital has happened. Yes, definitely. But yeah. Reduction of capital has happened. If you want, I can look up and tell you some examples, or you can look it up. But don't worry about it. Yes, it has happened. See, that officer abets means, say, two people are decided to do some robbery. I'm holding their knives, gun and all in my house. That is called abetting. I'm aware, or I'm suggesting the idea how to do it. That is called abetting. I am telling them how to do it. I'm giving them the plan of action. I don't actually engage in that, but abetting is where I'm supporting that crime. That is called abet. Privy means they have told me that officer has told that MD has told that officer, we are going to remove these 2-3 creditors. Please keep your mouth shut. So he is aware that these 3 fellows' names have been removed. He is privy to that concealment. Now, privy means having knowledge of, having private knowledge of. Okay? Or at the time of giving the information to the tribunal, he has misrepresented. He has said, all the creditors are included here. There is a misrepresentation, right? Where 3 fellows are not there. So that is also liable under this. Right? So, thankful to you for your patient listening. Yes, going forward, some of these classes we might extend by 10 or 15 minutes. But with this, I'm going to close today. Thank you and see you on Thursday. Bye. Session concluded. Thank you. Shall I leave?